Last episode ended with a number that should still be sitting with you. Thousands of dollars of debt before financial adulthood even started. Today's number might be worse, because this one isn't about debt you took on. It's about protection you thought you already had. By the end of this video, you'll know why having insurance and being protected are not the same thing. What actually happened to families in Maui and the Palisades who did everything right, and why your government has quietly decided the answer to this problem is to do nothing. That last one is the part most people never connect to their own policy. Let's get into it. Here's the story insurance sells you. Pay a premium every month, and when disaster strikes, you're covered. Illness, fire, the loss of the person whose income keeps your household running. Insurance exists to absorb that shock, so your life doesn't collapse along with the event. That promise is true for some people, some of the time. For a much larger group of Americans, it's a story that holds up right until the moment they actually need it. The insurance that doesn't insure. Start with health coverage because it's the clearest version of the problem. The United States is one of the only wealthy nations on Earth that doesn't guarantee health coverage to its citizens. Despite spending more per person than countries with universal systems, American outcomes on life expectancy and preventable disease still lag behind. But the deeper issue isn't the uninsured, it's the underinsured. People with a policy that's technically active and practically useless. High deductible health plans have become the default form of employer coverage, largely because they let employers shift cost onto employees while keeping premiums low. A family with a $6,000 deductible has insurance the same way a car that won't start has transportation. The thing exists. It does not do what it's supposed to do. For a household living paycheck to paycheck, that deductible isn't a number. It's a wall. Meet it before coverage kicks in, or delay care, or go into debt. Medical debt remains the leading cause of personal bankruptcy in this country. Not catastrophic uninsured emergencies alone. Ordinary families with active policies, drowning anyway. Notice what's already happening here. The same pattern from the credit system, from student debt, from retirement. The cost of protection keeps rising while the protection itself keeps shrinking. Is that a coincidence or a design? Hold that question. It gets worse before it gets structural. The ground itself stopped being insurable. Health insurance dominates this conversation, but the crisis runs wider. Property insurance, the policy protecting the roof over your head, is becoming inaccessible across entire regions of the country. Insurers have pulled out of whole states, refused to renew policies in high-risk areas, raised premiums until ordinary homeowners simply can't afford to stay covered. In coastal zones, wildfire corridors, and floodplains, the private insurance market hasn't just weakened. In places, it has effectively collapsed. You don't have to imagine what that looks like. It already happened twice in the most visible way possible. In Maui, families who lost everything in the Lahaina fire discovered their policies carried coverage limits that hadn't kept pace with actual rebuilding costs. Some found fine print excluding specific fire damage. Others ran out of additional living expense coverage long before reconstruction even began. More than a year later, many displaced residents were still living in temporary housing, unable to return to land they owned because the payout wasn't enough to rebuild on it. In the Palisades fires, the same story played out at a larger scale. Homeowners discovered policy limits set years earlier when construction costs were a fraction of today's. Some learned their insurer had quietly non-renewed them months before the fire. leaving them uninsured without ever missing a payment. Others are still waiting, months later, for claims that move at the system's pace, not theirs. These aren't edge cases. These are people who paid every premium, trusted every promise, and discovered in the worst moment of their lives that the protection they bought was smaller than the disaster they faced. And the market's response hasn't been to build better products. It's been to withdraw further. Insurers exiting states entirely, leaving residents dependent on state-backed insurers of last resort that are themselves straining under the claims they're built to absorb. For homeowners, losing that coverage can trigger mortgage default, since lenders require it as a condition of the loan. For renters, the absence of renter's insurance means a single fire can erase everything they own with no path back. And because the communities most exposed to climate risk are disproportionately lower income, built on land that was cheap precisely because it was risky, the people least able to absorb this loss are the ones standing closest to it. If any part of this sounds like something you've worried about, your own deductible, your own policy's fine print, hit like, subscribe so the next video finds you, and send this to the one person you know who still thinks being insured means being protected. The protection nobody sells to the people who need it. There's one more layer, and it's the quietest one. Life insurance exists to protect the people who depend on your income if you die. It's one of the simplest financial tools available. It is also one of the most unevenly distributed. Lower-income Americans are significantly less likely to carry life insurance, and when they do, it's more often inadequate. When a primary earner in that household dies uninsured, the family faces more than grief: lost income, funeral costs, housing instability that can take a generation to undo. The industry made this gap worse with a specific product: whole life insurance, which bundles a death benefit with an investment component and generates heavy commissions for the agents selling it. These policies have been aggressively marketed in lower-income communities as wealth-building tools, when a simple, far cheaper term policy would protect the same family more completely. The people least able to afford the wrong product have been sold it the hardest. Researchers studying healthcare access, including work published through the Commonwealth Fund, have tracked this underinsurance trend for over a decade, and the direction has been consistent. More cost shifted onto patients, fewer protections holding when they're actually needed. Why the gap isn't an accident. Across health, property, and life insurance, the same shape repeats. The people with the greatest need for protection have the least access to coverage that actually works. The policies available to them are pricier relative to income, more riddled with exclusions, and more likely to have been built to generate profit rather than deliver the protection they advertise. This isn't because insurance companies are uniquely villainous. It's simpler than that. An insurance company earns money by collecting premiums and not paying claims. Every dollar paid out is a dollar of reduced profit. The incentive to find a reason not to pay, through fine print, delay, and denial, isn't a flaw in the system. It's the business model working exactly as designed. So here's the question this video actually leaves you with. Every other wealthy nation has looked at the risk of catastrophic illness, disaster, and death, and decided some form of collective, publicly organized protection is the right response, not out of generosity, but because the math of private insurance applied to the most vulnerable population always lands the same way. The people who need protection most can afford it least, and the gap between the promise and the payout falls hardest on the people with no cushion to absorb it. America made a different choice. It built its protection system around private markets and individual responsibility, then acted surprised when that market consistently underserves the people at the bottom. The evidence that the gap is real isn't in question anymore. Maui proved it. The Palisades proved it. Millions of quietly underinsured families prove it every single month. The only question left is whether examining that choice means anything if nobody's willing to make a different one. Next time, the conversation turns to the tax system, not as an accounting exercise, but as a policy document that reveals exactly whose financial lives it was built to protect. Click the next video. Once you see what the tax code actually rewards, you'll read every paycheck differently.